Welcome to the 2021 Unique Graham Lecture. But we'll begin it as we usually do by awarding the Avinash Dixit Prize in International Economics. As most of you know by now, this is a prize that we award annually at the Graham Lecture to that student or students who have completed with great distinction their general examinations in international trade or in international macroeconomics, and who have written an outstanding third-year paper in one of these fields. The prize honors Avinash Dixit, who I was hoping might be here, but I don't see him on the list, who was a member of our department from 1981 through his retirement in 2010 when he moved to emeritus status. Avinash has wide-ranging research interests in economics generally, but in international economics, he's best known for his book, Theory of International Trade, which he co-authored with Victor Norman, and which establishes him as one of the founding fathers of the new trade theory based on product differentiation and increasing returns to scale. The prize includes, as always, a nice certificate and a nice monetary reward, but both of those will have to wait to deliver on another day. So I'll ask everyone to join me in congratulating the joint winners of this year's Dixit Prize. I guess you can use the little clap hands in Zoom if you want. But when I call your name, please come to the front of the room, or rather, please unmute yourself and say something so that your Zoom box jumps to the front. So the first winner of the Dixit Prize this year, coming to us from Singapore, is Hanan Zhao. Hanan, congratulations.
Thank you so much. I actually don't know what to say, but okay. Thank you so much.
Well, I hope you'll make it back to Princeton one of these days. Hanan is in the 14-day quarantine so that he can get from China back to the US according to the rules. So good to have you. You must be some awkward time where you are, so it's nice that you can make it.
Thanks.
And the second winner of the Dixit Prize this year is Hugo Louis. Hugo?
Thank you very much. Same as Hanan, I'm not sure what to say, but I'm very happy for the prize. Thank you.
Both these guys wrote terrific third-year papers. They've been recognized for them already by the department, so it's great for the IS to be able to recognize them as well. Okay, moving on. Today is the 68th annual Frank D. Graham Memorial Lecture, the first one and hopefully the last one to be delivered remotely. We tried to do this last year. Andy was gracious enough to wait out for another year. Andy, I want to say that the best part of Graham Lecture is the dinner and the party. And so we do intend to invite you to join us next year, if that works out for you. That's why I asked about whether your daughter was Delise, but we'll fly you out if you can make it. Frank Graham was a Princeton professor from 1921 to 1949, and the second Walker Professor of Economics and International Finance. Mark Aguiar is the current resident of that chair. Professor Graham published widely on international trade and international monetary issues. After his untimely death in 1949, the lecture was established by his friends to honor his memory. It's the signature event of the International Economics section, a little awkwardly signature this year, but be that as it may. It's been delivered over the years by a veritable who's who in international economics, including 10 Nobel laureates. It's my great pleasure to introduce today's speaker, Andy Atkeson. Andy is the Stanley M. Zimmerman Professor of Economics and Finance at UCLA. Before moving to UCLA in the year 2000, Andy held positions at the University of Chicago, the University of Pennsylvania, the University of Minnesota, and the Federal Reserve Bank of Minnesota. He's a fellow graduate of Yale and a record-setting member of its cross-country team. Parenthetically, he ran a time of 24:19 in the 1981 Ivy League championships, which was good for second place. And he completed his graduate work at the Stanford Business School. His research spans a variety of topics in macroeconomics, including the sustainability of international debt, the design of monetary policy, and the measurement of firm solvency. He has an early and well-cited paper with Bob Lucas on efficient distribution with private information, and recent influential work with colleague Ariel Burstein on innovation and firm dynamics in the open economy. In fact, looking over his CV, it's very difficult to characterize his work because it has reigned over such an impressive panoply of different topics. And Andy was a leader of the herd rush into COVID-19 research and has at least a half dozen papers on the topic to his credit. Today, he's going to talk about the sharp decline in the US net foreign asset position, which he and his two co-authors, who are both with us today, provocatively entitled The End of Privilege. So it's my pleasure to turn over the floor, or at least the highlighted Zoom box, to Andy Atkeson. And Andy should be able to share your slides at this point.
Yes, so thank you very much, Gene, for that introduction and for inviting me here. It's a great pleasure to give this, and let's see if we get the whole thing working in terms of the slides. So Gene, yes, we do call this the end of privilege, and because this is kind of a bigger lecture, the themes will be a little bit broad. There's been a lot of discussion of the US net foreign asset position in international macroeconomics for many decades. And we thought, because of basically innovations in measurement over the last 10 years and changes in what the data say over the last 10 years, it's worth revisiting the question of kind of what's going on with the US net foreign asset position and what does that mean for Americans. So I'll start the talk with just a picture of what has happened to the US net foreign asset position relative to US GDP since 1992. And just to set the stage for those who might not be familiar, the net foreign asset position is a measure of the difference between the market value of the financial claims that US residents have on foreigners and the market value of financial claims that foreigners have on the US. And actually, I guess you can see in my Zoom background, I bought a friend that you'll meet soon in a few weeks, a cicada from Brood X. Back when I was a child and I first saw these cicadas in 1970 when they came out, the US net foreign asset position really wasn't much of a concern. It was positive, largely because of US foreign direct investment abroad. But because there weren't really capital flows allowed, then private capital flows, then nobody really talked about it much. But as we see in the data and in the decades since that time, people have started to talk about it more, and it's now grown to be somewhat substantial. So what I want you to really focus on in this picture is that up until, say, the financial crisis, or 2007, maybe 2008, the net foreign asset position was pretty moderate as a fraction of GDP. And then in the last 10 years, say, it's had a very substantial decline. So the talk today is really about kind of first part, what happened, and then a second part, what might this mean for the welfare of Americans? So on the first part, just a quick overview of what's going on. I guess I mentioned 1970 when I first saw the cicadas. By 1987, when they came around again, the international capital markets had changed. There'd been substantial deregulation of private capital flows. And the United States started running substantial current account deficits in the Reagan administration. And there was quite a bit of concern at that time that if these deficits continued, that the US net financial asset position would deteriorate and in some sense perhaps be unsustainable. But the thinking about it at the time was really driven by, just the thinking that what mattered is the current account deficits themselves, that was going to drive the position. And then by 2004, when Brood 10 reemerged at Princeton, the thinking had changed. A lot of work, very important work by Pierre-Olivier Grinchas and Helene Ray that involved both data work and then, of course, analysis of the data, documented that changes, capital gains and losses were an important part of what was driving the US net foreign asset position. And they documented that what they referred to as a privilege for the US, that somehow the US managed to run consistent current account deficits from that Reagan era, up actually to the present day. But up till 2004, we saw even up as far as 2007, this did not result in a big negative net foreign asset position in the US. So it seemed like the US had a wonderful privilege that we could spend more than we earned on a consistent basis. And yet by earning substantial capital gains net on our foreign asset position, we could do so without, going deeply into debt as measured by the net foreign asset position. So we've seen in the graph that no longer seems to be true. Over the last 10 years, things have changed rather substantially. So since the cicadas are coming back, 2021, it's time for a reassessment, and we'll label that kind of US privilege is over. What appears to have happened, and I'll try to document, is that over the past decade, foreigners have actually enjoyed much larger capital gains on their asset holdings in the US than Americans have earned on their asset holdings abroad. And that in general, and here we benefit from the data work that has been done by the Treasury and the BEA and the Federal Reserve over the last decade. The picture that we had back in 2004, that what was going on was that the US was essentially long in equity, which yielded a high rate of return, and short debt, which has a low rate of return, that picture may not be correct. That what looks like actually is that the gross equity positions that the US has abroad and that foreigners have in the US are roughly balanced in size. And instead, what's driving these valuation effects or these relative capital gains is the question of whose equity market is outperforming. It's not about some kind of equity premium earned versus bonds. And so just mechanically, what we'll demonstrate is what happened to the US net foreign asset position is that the stock market in the US has boomed dramatically over the last 10 years, and foreign equities have not. And that has resulted, as I say, in this big deterioration of our net foreign asset position. So then in part 2 of the talk, what I want to try to discuss is how should Americans feel about this? What are the welfare implications of this? Basically, something is driving this US asset price boom and the associated deterioration in the net foreign asset positions. How should we feel about it? And to answer that question or address that question, we need a theory as to what it is that's driving the boom in US asset valuations. So we're going to turn to a recent paper in the macro finance literature for guidance, but extend it to look at the open economy. This is a paper by Fari and Gurio. There, of course, in the macro finance literature, there's quite a few hypotheses about what's driving the rise in the US stock market. We're going to end up, when looking at the data through the lens of its Fari-Gurio style model, we're going to end up putting a lot of weight on a story that it's rising profitability of US firms. Here we're going to model that as rising markups, It's also, there's contribution from cuts in the corporate profits tax. And we're going to argue that to the extent that this is what's driving the boom in asset values, this has potentially large welfare costs for Americans. And if you want to kind of see that quickly, in the model, the boom in asset values is going to be mathematically equivalent to basically having the US levy a value added tax and then take the revenue from that tax and send the money to foreigners. And so that gives you the intuition as to how we could have an asset price boom in the US, but since foreigners own a lot of the equity, they're actually getting the bigger dividends from it. Now, of course, the macro finance literature emphasizes some other factors as being very important. Changes in perhaps risk premia or real interest rates might be important in accounting for the change in asset valuations. So we'll have a little bit of something to say about that. Another story that is out there in the literature as well is that it's not rising markups that are driving the profitability of US firms, but it's a fact that production has changed and US firms are investing in a form of capital that we don't measure well. And that this rising value is actually reflecting accumulation of valuable assets that we don't see on balance sheets, so we're not measuring very well in the national income and product accounts. And I hope one contribution from this work will be that it's very hard to distinguish that hypothesis from the rising markups hypothesis if you look just at a closed economy. But if you look at an open economy, we're going to say there's sharply different implications of a rising markup story and a growing unmeasured capital story for what should happen to the current account. And we're going to use that basis for arguing that is probably not a story that puts a lot of weight on growing unmeasured capital. So that's kind of the outline for the talk, the two parts. So let me get started on that. So the first part is just documenting this, what happened with what we call this end of privilege. And as a reminder for people, the accounting for the evolution of the net foreign asset position of the United States can be understood in this first equation as follows. We start off every accounting period with a given, a certain net foreign asset position. And then we have a flow here, a current account, which would be a gap between income and spending. So that is, by an accounting identity, reflected in either an accumulation or a decumulation of financial assets. So that would be the current account and the capital account are flip sides of each other. In the data, of course, there's a statistical discrepancy. So the flows of purchases and sales of assets would be the sum of the current account and the statistical discrepancy. And then there are what are called measured valuation effects, where in the integrated macroeconomic accounts, the BEA is, together with the Fed, takes existing gross asset positions and then revalues the positions when you have changes in prices. And so we have the measured valuation effects, and then these three things together give us a new, a change from beginning of an accounting period to the end in the net foreign asset position. And so if you want to do a decomposition of what's going on, you can, over any time horizon, you can iterate on this accounting identity, and you can decompose the change in net foreign assets into accumulated current account. This and this together would be the capital account, and where's your room for, maybe we're not measuring flows correctly. And then you have the accumulated measured valuations here. Okay, so Garincious and Ray, in a series of papers, really emphasized the importance in this accounting that the valuation effects seem to be going consistently in the favor of the US, and that meant we could run current account deficits and yet not have a substantial deterioration of the net foreign asset position. And this is a graph that kind of conveys what they were seeing in the data. From 1992 to the end of 2007, we accumulate the current accounts and then divide by GDP at each time period. And so you see that if you run a negative current account year after year and you accumulate them, you have a substantial deterioration relative to GDP in these accumulated current accounts. But in the measured valuation effects, say between 2002 and 2007, we had a substantial capital gain in our assets abroad relative to what foreigners were getting in the US. And that meant that the net foreign asset position was actually improving at the same time that the accumulated current accounts were deteriorating. And so this gap by the end of 2007, which is, I don't know, 30%, 35% of GDP, would be our privilege. It was like just the benefit we gained from that. But then, of course, we had a financial crisis, and now we've had a new decade. And so if we continue this accumulation, what we see is actually the current account has continued to be negative, but actually not so bad. Since GDP is growing, we can run these mild current account deficits and not have the accumulated account relative to GDP deteriorate. So the line has gone flat. But the net foreign asset position has sharply declined. And that's because the accumulated valuation effects measured in the data have gone sharply against us by perhaps 35% of GDP. And so that's why we refer to this. It's now the net foreign asset position is actually worse than the accumulated current accounts. We're calling this the end of privilege. Okay, so this table just kind of summarizes things that over a period from 1992 to 2007, there was essentially no change in net foreign assets relative to GDP. There was a substantial accumulated current account deficit relative to GDP, but a combination of positive valuation effects and the statistical discrepancy offset that. Whereas since in the last 10 years, we have this 44% deterioration in net foreign assets relative to GDP. Not much of that is coming from the current account, substantially from the measured devaluations with a relatively small accumulated statistical discrepancy. So what's going on? Like, how did we lose our privilege? So what we want to do in the next few slides is kind of dig in and say, okay, just in an accounting sense, what happened? So when you look at the valuation effect and you say it's going to be using some change in prices to revalue existing positions, existing gross positions, you need a couple of things to be true. You need that the gross positions are large, and you need big differences in the price changes. So we're going to document that both of those things are true. We're going to go a little further and say, the asset positions have equity and bonds and other forms of debt. We're going to document that the measured valuation effects are almost entirely equity. You might have thought on the bond side that exchange rates and different currency bonds might make a difference, but it appears that for the US, that's just not the case.
Andy, can I ask something?
Yeah.
These prices, how well are they measured? How liquid are these assets? So that, are you sure that about these G's, these price growths?
Okay, so
how well do we measure that?
There are many questions about measurement, and I'll say a few words about them a little bit later. And so we're relying on a lot of innovations to measurement the BA has implemented in the last 10 years, and I'm sure there's more innovations to be done. But conceptually, when we're talking about equity, we're going to be talking about portfolio investment, which is generally then in publicly traded securities. So we're fairly confident about those valuation effects. A troublesome component is the fact that, when US corporations have foreign subsidiaries and foreign firms have US subsidiaries, what's on their balance sheet is a debt and equity position as a financial claim in the subsidiary. And so then the BEA has to do some imputation of what the value of that equity is. They, starting in I think 2014 or 2016, they shifted from measuring FDI equity at current cost, at historical cost, to measuring its market value. And what they are doing is they're basically trying to look at what they call publicly comparable firms, publicly traded comparable firms, and impute a price change for the subsidiaries. So this is the same type of procedure that they use to measure the value of privately held equity in the United States. It's the same imputation problem, and whatever errors are in one are in the other. But so it's for the stuff in the United States, they break down the firms by industry, and they use price earnings ratios by industry and price changes, and they try to then impute values off of that. So that, so I can't say much about how accurate that is, but that's an innovation they shifted in the accounting in the middle of this decade, and then did the historical revision. So a lot of it is an imputation based off of publicly traded equity. And so in some sense, you can imagine that once, I'm going to show you in a second, price indices for US stocks and foreign stocks. And once you see the price indices and you think about the imputation, then you go, yeah, that you have to get that answer if you do that type of imputation. So let me get into kind of documenting these. I'll call them facts. They're what are in the data as measured. Okay, so first they report in the integrated macroeconomic accounts, when they break the whole economy into sectors and they have a rest of world sector, the valuation effects for the rest of the world are the blue line at the total revaluation. And if you break out the revaluations of just the publicly traded equity and the FDI equity component, you see that accounts for the whole thing. So it's really not something about the valuation of bonds. And this idea that, is the US long equity and short debt, this is showing the gross equity positions. When I use the word equity, it's always going to be publicly traded plus FDI equity. This is the gross equity positions relative to US GDP. So you see back here, they were roughly balanced and a gap opens up. And then at the end of the thing, they're roughly balanced. But this is not, a substantial difference in the portfolios. So it's certainly the case that the US has quite a lot of net debt. And so we definitely are borrowing from abroad, but certainly in recent years and at times in the past, we've had roughly balanced equity portfolios relative to each other. In thinking about what's driving the equity valuations, an American investor abroad cares, of course, both about the local currency returns and about exchange rates. You can look at what we're going to call two valuation episodes. The time period from 2007 to 2007, when these valuation effects went very much in the favor of the US. This is the accumulated valuation effects over GDP of like about 25 percentage points of GDP in 5 years. What was going on with the underlying stock price indices using the Morgan Stanley Capital International stock prices was that the world ex-US, there's a world excluding the US that we're calling world stock prices, and the US stock prices from MSCI. The US is kind of puttering along, and the world ex-US is booming in dollars. But if you actually look at the world local currency returns, they're not, maybe that's the gray line. Yes, they're not so good. And so a lot of this gain is exchange rates. But if you go to the recent period in the last decade, and things have gone very much against us, you see in dollars, the US stock market, we all know, has boomed massively. The world local currency returns have been mediocre, and if anything, the exchange rate has made it even worse for an American, slightly worse for an American investor. So we emphasize that this valuation episode is probably different economically than this one. This one, well, zoom in here. This one is the same 2 episodes. Seemed to be a good portion of it was having to do with the dollar exchange rate. This one is very much about just the straight up boom in the US stock market. All right, so just to summarize that data, we have a situation where we have this 45 percentage point decline in the US net foreign asset position in 10 years with current account deficits only 8 to 10 percentage points of that decline. The dominant driver is equity revaluation effects. And we're arguing that is reflecting really a huge boom in the stock market that foreigners are benefiting from because they own a bunch of US equity. Okay, so if I say that was the data, let me turn to this question of how should we think about what this means for Americans? I mean, at one point I had a slide that said, Americans are wealthier than ever. Why aren't they happy? I mean, it's the case that if you measure household net worth or US net wealth relative to GDP, it's at the highest levels ever.
And
Okay.
can I add something, sorry, very quickly before you move?
Yeah.
I'm confused about the Great Recession in the story, in the sense that of it being a period of reduction in US equity with worsening of the foreign asset position, no? I mean, it seems to go in opposite direction of the story in a sense, or I have it wrong?
Well, okay, so let's see if this click works. So you can look at the actual gross revaluations of equity and FDI. And so I suspect, so this is the Great Recession. So we had this tremendous gain in valuation effects on our assets abroad and a mild gain of foreigners on their assets in the US. And then of course, in both cases, the crash to the first quarter of 2009 is a substantial loss for both parties. We should check. I think a good bit of this might be exchange rates, but this is just that we got our assets in dollar terms abroad just dropped a whole lot more than their assets in the US, but both of them went down. And then since then, you see the foreigners have just rocketed up, and we've had this, mild revaluations going in our favor. All right, so let's see if this works back. Okay, good. All right. So, as I said at the start, to interpret what this might mean for Americans or for welfare for Americans, we need to have a theory of what's driving the boom in US asset values. And
Andy, can I
so-
ask you a question? This also
Sure.
includes essentially Chinese reserve holdings in US treasuries and also their shift into the US stock market. Do you think these are tiny effects what the Chinese are doing, or is this, it's part of your numbers, I guess? That they don't go so much in US treasuries anymore and buy more stocks. Is this consistent with your story?
Well, you mean that just that the Chinese have changed their portfolio?
Yes.
It should be in the data. The story we write down is going to separate out. It's like we're going to be able to do production and valuation completely independently of who's holding the assets. And so we'll have a separation between, we need something that affects valuation, and then the impact on like who gets the money is just a question of what portfolios are. So changes in the Chinese portfolio would impact the second part of the discussion, and that will matter. But that in and of itself in the model is not going to be a driver of asset valuation. Okay.
Andy, could I just also ask as well, it's also very interesting, these persistent differences in rates of return on US equity and foreign equity, right? And I'm wondering if there's also a puzzle there in the sense that has the exchange rate moved in the way to sort of offset that and satisfy the equality of rate of returns on those two sets of equity, right? It's sort of quite impressive that over a decade, you have these really quite substantial different rates of return on equity in the US and the rest of the world. And my sense is the exchange rate's been relatively stable and it doesn't completely offset those differences. But
okay, so it's going to be an extremely important part of our story, and there it is in blue with Greenwald, Letow, Ludvigsen, that this is a surprise. That this. Let's see if I can. Himinori, you need to mute your iPod.
Oh, I'm sorry.
Okay, that the welfare implications we're going to be exploring was that this is a windfall, and Greenwald, Letow, Ludvigsen is a paper we'll point to where they're going to, when they explore what was the drivers of the increase of the US stock market over a much longer period of time, but their analysis applies to the past decade, is that there was basically an unpredictable sequence of factor share shocks that reallocated rewards to shareholders. And so what the eye sees as a decade of increase of the US stock market, we're fooled into thinking that that's expected returns. It's just a sequence of favorable shocks. Mm-hmm. We won't get into the dynamics in our model because you'll see that's something worth pursuing down the road. And there's a lot of discussion about what might this factor share shock be. And of course, the corporate tax cut of 2017 was part of that. And Paul Krugman said a lot about that. That's actually connected to our hypothesis here, that it was a windfall for foreigners who held US equity. Okay. Now, the macro finance literature also finds very important changing discount factors. And so we'll have some discussion of that. And as I mentioned in the introduction, there's some discussion in that literature as well about unmeasured capital. And we think that by thinking about things in an open economy setting, we might be able to make some progress on distinguishing between unmeasured capital and this unanticipated factor share shock.
Andy?
Yeah.
Quick question. So my impression is that the labor share or the cost-weighted markup fell before 2007 and has been pretty stable since then. Whereas the trends that you're talking about with assets have really accelerated since 2010. So how should I think about that?
I'll show you a picture. Remind me to show you a picture when we get to the data about that. So we're going to have some time, I believe, and so let me hold off on that question and address it when we're looking at the data we're using for valuation. Okay, so here's what our approach is. As I say, related to what Fari Gurio did. We're going to have a simple, very rudimentary quantitative macro finance model that can incorporate these factors. It'll be an open economy one. And the goal will be we have a small number of parameters, and we want to hit asset pricing moments that we see in the data, like before and after, basically. So the asset pricing moments we'll be thinking about will be what they call the Buffett ratio, or the value of equity relative to GDP, Tobin's Q, which is the value of equity relative to the replacement value of the capital stock, and then measures of discount factors, which would be the price dividend ratio, or the dividend yield we'll actually use as the inverse of this, and the price earnings ratio, or the earnings price ratio. So we're going to want to say, like, how did parameters have to change to go from one set of these asset pricing moments to another? And then once we have that, we can say, given portfolios, what are the corresponding implications of this asset price boom for the net foreign asset position, both the flows in the current account and for the valuation portion and for US welfare. So that's the strategy. So let me talk briefly about the model. It's like super simple. We're going to model the US as a small open economy. So we're just going to be taking from the rest of the world a discount factor, R star, for valuing everything. And in the model, the firms in the US, and I want to be precise that this is the US operations of firms that count towards US GDP, they're going to compete monopolistically, and that'll mean that their equity prices reflect both the value of the physical capital that they own and claims to future monopoly profits. We are not going to be solving an optimal portfolio problem. We're going to be taking the equity portfolios of US and foreign investors as given, and then as an accounting saying, how is the impact of an asset price boom given those portfolios. To finance current account, there is free trade in a risk-free bond that goes back and forth. And one of the questions we have to address when we think the profitability of US firms went up is, did that go up because the US firms got more productive and that opened up room relative to their competitors for them to raise prices? Or did they have the same productivity and instead something happened to make competition more difficult, and that allowed them to raise prices? We'll tell you how we resolve this when we get there. And we'll also be able to consider a change in the discount factor and the trend growth rate of the economy.
Andy, can I ask you something? So why should I think about like a US kind of resident or a foreign resident? Why not just think about people that have portfolios and how you're going to benefit or not from these trends just depends on whatever your portfolio happens to be during this period? I mean, why don't I think just as individuals with portfolios and that's it? Why do I need to kind of group this at the country level? In what sense is that particularly interesting?
Oh, okay. So you're exactly right that a country is comprised of a bunch of individuals with different portfolios, and
they are different, and I guess how well you're going to do from this depends on what your portfolio actually is, right?
Yes, but then why is it interesting at the country level is this idea of home bias in portfolios. Americans tend to have mostly American equity and foreigners mostly foreign equity. That has changed over time. And so we have increasing international diversification. And, so the value, because there are these systematic differences across portfolios by nation of residence, there'll be in the aggregate for Americans, an effect that we can point to that's different for foreigners, and that's what we'll want to focus on. Within Americans, I totally agree, there will also be heterogeneous impacts, but if we think about Americans as a whole, what do they get? They get labor income, and they're going to get some portion of the dividends coming off of these firms, depending on the extent of home bias in equity portfolios.
So Andy, can I ask you a different question? I try to understand. So the end of the privilege sounds like it's a permanent shift. It's a regime change. But this change, this unanticipated shock in the markups, that's a one-time temporary thing. Do I miss something there? Or do you think it will go on? We will be surprised continuously, even later on in the future.
If there's time for discussion afterwards, there was a very interesting Vanguard document from December 2020 that made a forecast that it was going to flip and go the other way. And I can discuss where that forecast came from. So, well, specifically, I can tell you this. If you were to take the view that most of what was going on is a change in discount factors, that the discount factor in the US was different from that abroad, and that there are times when the US discount factor is high and times when the foreign discount factor is high and vice versa. Vanguard used this to make an argument that that basically going forward, the US stock market was going to perform poorly and the foreign markets were going to perform well. So this valuation effect would undo itself. But we're disagreeing with Vanguard on that, but it was that would be I think you would see a lot of finance people who might say something like that. To the extent that price earnings ratios forecast returns and US price earnings ratios are very high right now, you might forecast that going forward, the US will get lower returns. On the question about privilege and predictability, I'm not sure the US ever had privilege. I think that what happened before could have been also just a lucky exchange rate shock. It's very difficult, as you might imagine, given the variability of returns. In the short samples that we have, it's very difficult to establish convincingly that there actually were differences in expected rates of return. So I'll just say that that's hard to establish.
So Andy, just on that, and maybe you're going to come to it later, but another one of these facts from that older literature was this net factor income goes in favor of the US despite the negative position. That was another thing that gave credence to this, that we're holding equity abroad and getting a higher return and they're holding debt here. But is that still a fact? I haven't actually.
It is still the case that we have a positive net foreign income flow. My understanding and our discussions of this is a lot of this is connected to profit shifting and tax schemes that would affect the decomposition of the US current account into exports versus factor income, and but not change the overall current account. So I have not seen a claim that that type of tax avoidance activity by US multinationals would drive the measurement of the net foreign asset position, but it does appear to have a substantial impact on what is measured as net factor income. And that's perhaps why we're able to maintain, my understanding is that's why we're able to maintain a positive flow. That there's this, basically by pharmaceuticals and tech companies putting their intellectual property abroad, they're able to claim that, oh, look, we got to pay Ireland and some other places all this money to use this intellectual property. Instead of having it be an export of the US, it's counted as an export of Ireland, but then Ireland makes a big payment back of a dividend to the parent. And so in the terms of those items are both in the current account. So the current account is not distorted by it, but the components of the current account are distorted. So I hope that partially addresses that question. Okay, so let me just get to the components of the model. It's pretty standard. We're going to have, the US economy, the corporate sector, which is both the non-financial and the financial corporate sector, is about 57% of total output. Of course, you have the household and the non-financial, non-corporate sector and the government sectors. And so when you talk about total GDP, we're not modeling the other part, the non-corporate sector, and we're saying foreigners can't invest in that anyway. But when we look at statistics, we always have to be careful. Are we thinking in terms of overall GDP or just the value added in the corporate sector? And so what I'll be talking about here is the production, the value added in the corporate sector. It's produced from, intermediate goods producing firms that have some monopoly power and face the standard CES downward sloping demand functions, but they price at a markup coming from Bertrand competition with a latent competitor. So we're going to think of each variety as having a leading firm with one productivity in here and a follower firm with a lower productivity here. And this will be the production function. This big Z is just going to be a trend growth in labor augmenting productivity to drive trend growth of the economy. And we're going to think of these firms as renting capital and labor at, at competitive factor prices.
Indeed.
Yeah.
I guess you can get some of these effects with an increase in alpha.
I'll talk about that.
I mean, I was wondering. I mean, I was thinking about the Ludwigson Greenwald paper. I think that seems like that's what kind of they have in mind. I mean, it's sort of a redistribution shock.
Yes, we're going to have a redistribution shock, but when I get to the unmeasured capital, that's the shock we'll have in mind, that the importance of unmeasured capital in the production function went up. If you just shock alpha here, you should have an increase in the capital output ratio, and that's going to be one of our statistics, and you don't have an increase in the capital output ratio. So
there's no increase in the capital output ratio. You mean over which period?
Since pretty much ever.
No, I don't think.
We'll look at the graph.
Okay. Okay.
That's the okay.
Okay.
So firms. So as I said, these firms,
Andy, just a follow up to John. I guess your story doesn't attribute any role to differential wage growth across countries as entering into this at all, I guess.
Well, we don't have to know anything about the wages in the other countries because we want to value these firms.
Well, I guess I think you might think differential wage growth has affected relative profitability.
Oh, but we need to get in absolute terms. When I show you the moments, you'll see that we can define a bunch of asset valuation ratios relative to the US economy so that, and there's been this huge boom in asset values relative to the size of the US economy. And so that's really what we need to explain. Now you could ask, so for the moment, I'm not going to talk at all about the foreigners because in the data, we saw nothing special happened with the price index of the foreign stocks. We're going to just think of that as being unchanged between the time periods. We need to account for the gross valuation of foreigners' equity claims in the US. So we need to get the boom in US equity values relative to US GDP. Okay. So anyway, so to continue, there's also a firm or a division of these firms that owns and manages the physical capital stock, and that firm just rents it out and invests and maximize. This will be its dividends, and it maximizes the discount present value of dividends. And in terms of solving for the households, the consumption and labor decision, we're going to use GHH preferences that allow us to solve for labor supply independent of consumption. And this will allow us to solve the production side of the model and then figure out consumption because it's an open economy model based on the wealth of US households. And I'll show you where that comes in. Okay, and when we think about the portfolios, and I guess this is Esteban's question, as I said, we're going to fix those portfolios. We're not going to account for them as an optimal decision. We're just going to imagine that US households hold a certain fraction of the shares of US firms, and foreigners own, and a certain fraction of the shares of foreign firms. And they hold that all the time. So in their budget constraint, they collect that fraction of dividends from those two firms. But they do choose a bond holding that they'll use to finance any, gap between consumption and income, and they'll get the labor income. And this is the principal and interest on bonds. And the dividends that are paid out from US firms, and similarly for foreign firms, is the combination of the dividend that you get from managing the physical capital stock and any monopoly profits that the intermediate goods firms are obtaining. And we're just going to value equity at the discounted present value of dividends at this world discount rate, R star. So when you solve the model, it's pretty simple that these equations are true all the time. You'll divide the output of the corporate sector up into shares that are implicit rentals of physical capital, a labor share, and then the rest is a monopoly profit share. From the Euler equation for physical capital, the optimal investment, we get that the rental rate on physical capital is the standard formula, but here we have the world discount factor, R star, plus the depreciation rate. And because of the GHH preferences, the wage rate is just this labor augmenting technical change, the labor supply to the sigma there. So you notice consumption doesn't come into that formula. And so from these equations, you can solve essentially the production side of the model. And the dividends and earnings implied by that are just these formulas here. So that when we talk about dividends, what we're talking about is the cash flow from operations of the portions of the US firms that are located in the US. And similarly for earnings, this would be the earnings attributed to those operations. So we'll be thinking, for the finance people, we'll be thinking about what we call an enterprise value of the US resident operations of firms. And the dividends is the cash flow of operations for those firms. So when we talk about the valuation of these firms, it's essentially an unlevered valuation, unlevered enterprise value of these firms. Okay, so this is helpful for thinking through what is, what will be important for asset pricing moments. As I said, a firm is a discounted present value of its dividends, but we have no adjustment costs in physical capital. So you get immediately that the firm is the value of firms is the value of the capital stock that they have on hand, plus the discounted present value of monopoly profits. So if there were no monopoly profits, what we call Tobin's Q would be equal to 1, value would be equal to capital. It exceeds 1 because there are some monopoly profits here. And
there's no risk premium anywhere, I guess. Or is it in R star?
It's R star, yeah.
Okay. And you hold lambda fixed all the time because you said the main argument was that the portfolio is now different from earlier, or is it?
Well, I'll show you. What we do with lambda. So as I say, we're going to be able to solve for the production and valuation implications of the model independently of portfolios. And then I'm going to actually just show you a graph of like what would happen as a function of lambda. So you can think about a lot of different lambdas when I show it to you. Okay, so basically, if you imagine that the economy is on a balanced growth path, and because this is a small open economy with GHH preferences and no adjustment cost of physical capital, it actually goes immediately to the balanced growth path. And so we'll be taking advantage of that. So we want to, what we want to confront the model with is a bunch of asset pricing moments before and after. And as I say, the model has these 5 parameters down here, and we want to basically choose the parameters to match the moments. So what are the moments? What is the value of US firms relative to overall GDP? What is the capital output ratio in the corporate sector? What is the earnings yield, or the inverse of the price PE ratio for these firms? And what is the dividend yield, the inverse of the price dividend ratio? And the labor share. Now we throw the labor share in for interest, and there was a question about it. So in a slide or two, I'm going to actually show you that the dividend to output ratio does follow the right timing to get the boom in this, or a good timing to get the boom in the stock market. For finance people, I do want to point out something. There's a lot of thinking. Normally, you're used to the formula, from the Gordon growth formula, the dividend yield is R minus G. And normally, when Tobin's Q is equal to 1, this term disappears, and the earnings yield is equal to R star. So normally, you would say, I see the PE ratio rising dramatically in the United States, which is a fall in the earnings price ratio. So if I ignore these terms, I'm inclined to think what must have happened is a big decline in the discount factor, whether it be risk premium or the real interest rates, we could debate, but a rising PE ratio is a falling earnings yield. And the normal thinking, if we eliminate these terms, is that that's a decline in discount factors. That turns out not to be true when you have deviations from Tobin's Q. So when we have monopoly profits driving up Tobin's Q or down this ratio, we're going to get a drop in the earnings yield pretty easily, just straight from increasing monopoly power. So I just want to highlight that. We don't get the full effect, and I'll show you what we have to do to match both of these statistics. But the standard finance intuition needs to be corrected when Tobin's Q doesn't hold. All right, so what happened to these valuation ratios? So we have some time, so let's show them. Okay, I mentioned that corporate asset values increased by quite a lot. And so this is a graph of the measure we're using for the market value of US corporations and the replacement value of their assets, both relative to overall GDP. So the replacement value of their assets is the stock of capital relative to GDP. And so when, I think it was John Luca who said, what about the capital output ratio? We see very little movement in it, since 1992. On the other hand, there's been quite large movements in the market value here. And so in particular, from say about here to here, this is where we're getting, it's going up by 150% of GDP. So that's quite a big boom there. So this would be, that graph showed you basically big boom in market value, little change in the capital output ratio. Now we can use the same measures that I described for the corporate sector as a whole, and we get a P ratio that moves up and down quite a bit. And here we see now it's climbed quite a bit. So this is the dot-com boom when the PE ratios were quite high, and then we're at high PE ratios again. And as I say in the finance literature, many people look at this and say, expected returns on US stocks going forward must have fallen. Then we have a dividend price ratio. And this is something Fari and Gurio emphasized. It bounces around a bunch, and during the tech boom, we had a substantial decline, and then it came up. But if you kind of look here, it's still about 3%. There's, during the financial crisis, stock market fell, payouts from corporations did not, and then we're kind of in this situation where it's being quite stable. So you have this different behavior between the price earnings ratio or the earnings yield and the dividend yield. And rather than talk about the labor share, I think it's interesting to just look at what about dividends over output? And they jumped quite a bit. So they were going along at 3.5%, 4%, and then in this time period, perhaps a bit higher. And then we come out of the financial crisis and they're about 7% of GDP. So this is not the measure of dividends that you would see in CompuStat. This is the cash flow from operations of US firms, and that has just jumped quite a bit. That is impacted by the labor share, that is impacted by corporate taxes, and it is impacted by investment choices. And so one can't quite see the labor share directly in this, but the timing does look like the profitability after tax just jumped quite a bit. So this is what we're going to be working with in terms of matching the model to data. And so let me just do this here and explain the experiment that
Sorry, Andy,
yeah.
very quickly, but why is the, shouldn't we also look at these moments in the rest of the world and match these parameters also in the rest of the world? Because I thought that for your sort of, how do you call it, expropriation, reparation argument from the beginning, I care about the net, no?
Okay, so yeah, it would be nice to be able to do that. Here's what the issue is. In 2008, there's a big meeting to revise the system of national accounts worldwide, and to produce this thing called the integrated macroeconomic accounts that links cash flows and balance sheets, that has all this stuff about where you can take a sector and see all the normal flow variables, but also see the balance sheet and the financial transactions and the valuation effects. So everybody eventually is supposed to do this. But the US is the only country that has actually done it. So there's a data barrier to doing this for other countries. We would certainly be doing it, and there's some data available, but the US by far and away has the most complete set of these integrated macroeconomic accounts. So that's where we are. But so what you're going to be able to see from this analysis is the portion of the revaluation effect that is coming from the gross revaluation of foreigners' portfolios. And we would then just have to take from the US data what the gross revaluation was of the US portfolios. But that's the place where we are, I think, given the data limitations. Okay, so let me see if I can get back and explain this table. We're going to have some pre-2009 moments and some post-2009 moments. So pre-2009, we have these 5 targets for the asset pricing moments. Well, capital output is a macro moment, and then a labor share. And that gave us the model on a balanced growth path hits these moments with these parameters. So I'll just draw your attention to, this is total growth of the economy. So you would think you were pricing in pretty good growth, or relatively high, so the R star must include something of a risk premium, and very little monopoly profits. There's your capital share and your depreciation rate. And then we say, okay, we think we have these 3 new asset pricing moments here. We're going to leave alpha and delta the same, and we're just, what do we have to change them to hit these 3? And what you see is we have to have a very large increase in the extent of monopoly profits. We have also a parallel decline in the growth rate of the economy and in the required rate of return, which is again a combination of a real interest rate and equity premium. But it's a parallel decline, so that means the dividend price ratio R minus G doesn't change. But with this big increase in the Buffett ratio, with virtually no change, this is an implied change in capital output and labor share, we get a big increase, as we see in the data, in the price earnings ratio. So we're getting, I guess there is a decline in the rate of return, but a good portion of this increase in the price earnings ratio is coming from, mechanically, from that extra term that has a big increase in Tobin's Q. Okay, so this is all done without specifying who owns US firms. and thus we don't really have any implications yet for welfare. So to do that, we need to specify, who owns the U.S. firms, and so I guess relative to Pablo's question, implicitly what we're doing is holding fixed dividends from the rest of the world when we do this. So we're just looking at the impact on the total through this change in U.S. valuations. And so like how much equity do foreigners earn? There's various measures of that. You could compare their holdings of equity, both public and FDI, to the market cap of the publicly traded firms in the US. You have the Fed's estimate of the value of both public and private equity in the US. And we have this broader notion of what we call the enterprise value of the corporate sector. And so we're going to say, since this is the measurement concept that we're using, we're going to say, a number like 0.3 is reasonable to think of in terms of our model. And in doing the experiment, as of coming out of the financial crisis, the U.S. did have a negative net foreign asset position of about 20% of GDP, which we're saying is debt, and we're writing the equity positions in the prior period as being matched, so that the net foreign asset position, the equity positions are matched, and the net foreign asset position is that the U.S. is borrowing. When we have this shock, when R star and G are both changing, we'll actually be using log utility, so everything, you can change them both and everything will be fine. And we'll have a labor supply elasticity here, because there's going to be a welfare consequences of having higher markups that in terms of discouraging labor supply, and we'll use this too as a labor supply elasticity. As I say, because capital can be instantly reallocated following the shock, you transition immediately to the new balanced growth path. And so what we do in this graph is say, okay, what is the change in the net foreign asset position to GDP upon the shock that comes from the current account and comes from asset revaluations as a function of what fraction of US firms are held by US residents versus foreigners. So if the fraction here, lambda, is 1, that means Americans own all the firms. And down here at 0.7 is the number we think is reasonable, would be foreigners earn 30% of the value of US firms. Okay, but first, what happens on the production side? When this shock occurs, we have a lower discount factor, but a higher markup. So very slight increase in capital relative to GDP. Oh, and I should say that when we choose this increased markup, as I mentioned, we have to decide how much of that is coming because leading firms got more productive relative to their latent competitors versus, maybe competition policy or something driving the latent competitors down. So we're just going to make a choice there that US output stays the same before, on impact, before and after. So that's actually going to mean that most of what has to happen to get the higher markups is that leading firms in the US got a lot more productive. And so that is going to mean you're going to see some things that this will imply benefits from the US for the US that are then reduced by the fact that foreigners own a good bit of the firms. Okay.
Andy, just a quick question on the welfare. Don't we have to take a stand on how much of the markup is paid by foreign customers versus domestic customers as well? Or are we just ignoring that?
Okay, we don't. So what we have in this model, in this model, the answer is no. So what we have in this model is these intermediate goods that are priced at a markup produce a final good whose world price is normalized to 1. And then that's, since it's a small open economy, that's being sold everywhere. So there's no terms of trade effect coming in for the US. And so because of that, if US firms charge a higher markup and we have this, single final good that's being traded everywhere, the incidence falls entirely on US labor. You just reduce wage. That's the only thing.
So
That's the only
it's not like Apple charges higher prices everywhere in the world, and some foreigners own some Apple shares. That would be a different calculation.
Yes, and what would particularly be different is if you thought of the firms like Apple also applying a markup to its employment of foreign labor. We don't have that. So in other words, if you thought that what happened is Apple got more productive no matter where they produced, and hence charge higher markups, then there would be effects that foreign workers would also be paying for some of these markups in terms of reduced wages. So that would be an extension that one could discuss. We do not have that. But what we want to draw your attention to, and I want to make sure I can get to the final bit and then we can have more discussions, is if Americans owned almost all American firms, this boom really doesn't do much to the net foreign asset position. There's a bit of a current account deficit. What does that due to? It's the fact that the capital output ratio went up slightly by about a little bit. So you have to finance that by running a current account deficit. And there's no revaluation effects because foreigners don't own any of this equity, so they don't get any benefit from the revaluation. Once you get to foreigners owning 30% of the firms, since the value of the firms boomed by 150 percentage points of US GDP, the foreigners are getting, what is that? 0.3 times 150, they're getting this very large, well, there's some changes because of R and delta, but they're getting this very large revaluation effect and a moderate impact coming from the current account is adding up to, almost a 45% percentage point deterioration relative to GDP of the net foreign asset position. So the fact that this asset boom in the US is related to this revaluation effects in the net foreign asset position in the US is just mechanically coming from, well, because the foreigners are getting a good portion of the boom. Okay. Now, the welfare effects, there's a lot of welfare effects. You got decline in labor earnings, rise in profit income, you get some more leisure, bunch of stuff happens. Let me show you a picture. So as I said, we're modeling this increase in markups to keep output constant before and after. We're modeling it as a pretty big increase in the productivity of the leading firms. And so if US citizens owned all these firms, you have some distortions coming from the monopoly markup, but you get a pretty big boom in their consumption and in their welfare. This is the consumption equivalent boom in welfare. On the other hand, if foreigners own 30% of US equity, it's natural. You're now turning over a lot of dividends to foreigners. And so the consumption boom is not nearly as much, and the welfare impact is not nearly as much. So the punchline there is you take what would have been a pretty big gain, 8.7% of annual consumption, and you basically more than cut that in half in terms of a welfare gain. And it obviously gets worse if you got to 50-50 there. So this is a windfall for foreigners. And as I said, the way to think about it is the welfare implications is, the markup is equivalent to levying a value-added tax. And then the dividend, the lambda is just determining who gets the tax revenue, and a good portion of it's going to foreigners. Okay, so I'm going to finish on time, which is good. Let's think about this issue, whether, an alternative story is, could have been just production has changed. These wonderful new tech firms and pharmaceuticals have this unmeasured capital. And so I write a production function this way along the lines of, say, what Gianluca was discussing. And, when you have a model with unmeasured capital, you have output, but that's not what's measured. What's actually measured is output less unmeasured investment, because you're measuring from the expenditure side. And your asset valuation, if we have this is all perfectly competitive, we have no monopoly profits and no adjustment costs. Your asset valuation is according to Tobin's Q, but you just have to take into account the fact that there's a whole bunch of this unmeasured capital. So the value of firms would be the total capital stock, unmeasured and measured. And you might imagine, as Gianluca mentioned, what happened was we shocked this new parameter, made it smaller. So measured capital and labor became a smaller part of the production of output, and unmeasured capital correspondingly got to be more important. And this is actually, in a closed economy, isomorphic. In other words, given the asset moments that we have in the labor share, the measured capital output ratio, you got the same game you can play of 5 parameters and 5 moments, and you can map the two together, and you could say, oh, okay, it's hard for me to tell the difference. But once you go to an open economy, the difference becomes fairly obvious. To pursue this story to its rightful conclusion, what you'd have to say happened in the United States is that we've accumulated 150% of measured GDP in unmeasured capital, because that's how much the value of firms has risen. And so somebody would have had to invest a ton to get there. And particularly given that measured capital is only like 1.2 times measured GDP, and this would have to be 1.5 times measured GDP. And if somebody does that investment, that implies you would have had massive current account deficits. So you would see the difference between the two stories in the trade or the open economy side of the model. Now, what would it mean for welfare? Here, it's very different than the story we just told. There's a very different implication for welfare of what we had previously, which we would call a windfall gain for whoever owned US firms, to a situation where we had a change in the production function that opened up investment opportunities, but to take advantage of those opportunities, somebody has to invest. And you would have the same thing. Well, if I have to invest to get the capital, to a first order, I get nothing out of it. So in that case, the distribution of like who owns US firms doesn't matter for welfare at all, if that was what was driving it, because the only way the foreigners would get a more valuable portfolio is if they contributed to the investment in these firms. And so this thinking has very different implications, as I say, for welfare and what's driving it. But so that's like a normative implication. But the positive implication, I think, is important to bring into the macro finance literature, is that the current account should be another fact that we target when we think about what's driving the U.S. stock market. Okay, so to wrap up, we've talked about just mechanically what's happened to the U.S. net foreign asset position and how it's driven by the relative performance of U.S. and rest of world equity values. As possible, if we find more of it, we'd like to get more data on what's going on in the rest of the world. And I think there's something in the second bullet point for the macro finance literature to, as I say, bring in the open economy in thinking about how does that help us understand the US asset valuations. And this whole idea of, is the shock that's changing value something anticipated or unanticipated, i.e., if it's anticipated and hence requires investment to take advantage of, it's a very different animal than these unanticipated shocks. While we don't mean to deny that the interest rate has fallen and growth rates have fallen, we didn't find that these impact the welfare implications much. If we did the model with just the markup shocks, you get kind of similar numbers for the welfare implications. It's the increase in the markup that is really driving things. Yeah, and so I said this already. And with that, I will stop and see if there's any other questions or comments people want to give.
So Andy, I have another question. So let's suppose the Biden administration suddenly changes antitrust regulation and markups go down unexpectedly, or the corporate tax would go up. Would you expect then the privilege comes back?
Okay, so it's a funny thing about the corporate profits tax. So Paul Krugman wrote about this a lot and made the argument that the 2017 tax cut. So let's step back and say, if you allow firms to expense investment, then the corporate profits tax doesn't discourage investment. It just changes who gets corporate profits. Do the private owners get it or do the government get it? And so Paul Krugman's line was, I don't know how much we cut corporate profits taxes by, maybe 2 trillion over a decade. And so he said, Donald Trump just made a gift of $700 billion to foreigners because foreigners own about 30% of US equity. So if Biden raises the corporate profits tax and keeps the deductibility of investment, it's just taking the money back from foreigners.
And from Princeton endowment, from tax exempt institutions, I guess.
Yes, them too. So Princeton, it'll take it from Princeton and foreigners. Exactly. And those of us who don't have an endowment would be cheering for this particular innovation. But the point that if John Cochran were here, I'm sure what he would say is, no, Andy, you're wrong. What's going on is that there's changes in the discount rate, R star in the US differential from abroad. And that's where, there's this standard Shiller CAP graph that says, let's look at the price earnings ratio today and look at the rate of return that is realized over the next decade. And you see both in the US and abroad, if you look at 130 years of data, very nice downward sloping relationships. And so what Vanguard was saying is the US has a very high PE ratio. So if we forecast returns going forward, they're going to be low. And foreign stocks have a moderate PE ratio. So if we forecast returns going forward, they'll be reasonably high. And so that'll mean a lot of these valuation effects might undo themselves going forward. Our response to that would be, I almost want to use the phrase, this time is different. That the high PE ratio this time is coming from that Tobin's Q term that is impacting the earnings yield rather than from a change in the R star term. And so that the high Shiller CAPE that we see now is not a signal of dramatically lower returns in the US going forward. Of course, anyone who uses the phrase "this time is different" to talk about the stock market, has to eat crow in the future. But so I guess I'm recorded, so that's unfortunate. But that would be what I might say in response to that.
Andy, and why is the lambda not changing given what we're seeing in the relative returns?
Over the last 10 years? What are you asking?
Yes.
Oh, because just imagine that we started the decade and foreigners owned 30% of US stocks and they had, a representative portfolio. at the end of the decade, they're still going to have 30% of US stocks.
Yeah, but why are the different parties not rebalancing their portfolio given the expected returns that they observe? I mean, what is determining those lambda? I mean,
well, so that's okay on the portfolio equity.
I mean, the lambda is the portfolio, right? I mean, in the
no, because it also includes FDI equity.
Yeah, okay, but I mean, the relative foreign versus domestic, I guess.
Yeah, but so the factors that drive FDI are probably quite different than the portfolio, because you know the optimal portfolio considerations you think of about publicly traded equities, and so the overall lambda is a mix up of those two things. But you know, there's also Andrew Eisfeld to me had a funny story that a bunch of US investment managers had persuaded their clients at the beginning of this decade to internationally diversify. And now the clients are suing them by saying, if we'd left our money in the US, we would have made a lot more money. And, you know, so I think pension funds, et cetera, go through waves of fashion as to, you know, how much diversification they're going to do. I'm not entirely confident that the portfolios that we see, even for the publicly traded stuff, is a reflection of some kind of Markowitz optimal portfolio theory.
Okay, and one more is, so just to make sure that I understood correctly, if you start doing antitrust policy and lower those markups, you may correct some of this net foreign asset position issue, but US, in your model, given the way you are modeling things, welfare in the US would go actually in net go down, right?
No, it would go up because if you're actually reducing the markup by allowing ZL to get closer to ZH, you know, from below, so that the Bertrand limit pricing markup gets smaller, then you basically think about it as what you're doing is you're shifting GDP. Well, first, that
I mean, there's an efficiency gain there,
yeah,
obviously.
but then the distributional implications are you're reducing, you're raising the labor share, and Americans get 100% of every dollar that goes to labor, and you're reducing the non-labor share, and Americans get only 70 cents of every dollar that goes to the non-labor share. So by doing that, you have a, if you sneak that policy in, you have a windfall loss for capital holders and a windfall gain for labor, and the net effect, because
you have an adjustment in productivity. Didn't you calibrate it so that the total
we did
output?
when the market go up? But your experiment, if I understand your experiment, is you're leaving productivity the same, and you're just saying, if I
see. So you're dropping that adjustment. You're right. So if you drop that adjustment, I agree. But
yeah, yes, yeah.
But if you just do exactly the same exercise you did on kind of in the opposite direction, you would get the.
If the reason U.S. markups fell was because productivity growth of U.S. firms faltered, and hence,
and you would correct this problem, but welfare would go down.
Well, because that's bad.
I mean, that's the counterpart of the exercise that you're doing, right?
Yes, exactly. So I don't want you to emphasize the level of the gain. In other words, the fact that the intercept here is positive is really not so much what's interesting. It's that how different these two things are depending on portfolios. Because as you say, we can shift the intercept by changing the assumption of what drove the change in markups.
Right.
But this gap will be substantially the same because of this first order effect that you're just sending a third of the dividend income abroad.
Question of what drove the change in markups is also interesting though, right? Because another feature of the data with this sort of measurement puzzle is that at least at the aggregate level, we actually don't observe rapid US productivity growth, right? Or it's been very, very hard to find that in the aggregate data. Yeah. We do observe some shift in the firm size distribution, and there's some big firms that one might think are taking advantage of new technologies. But another interesting feature of the data is we actually don't measure this rapid productivity growth, right? I mean, do you have any thoughts as to what's driving those movements in markups?
not beyond this simple thing here. I know that's a massive literature, and we're not looking to wade into it. I mean, I think we need to find a way to draw this picture so that we take your eye off of this and get you to focus just on the difference, because that's, I think, the main thing we have to say.
And on another measurement point, I was wondering, Apple and other US companies also have a lot of assets abroad, but sometimes those are actually sort of booked in Ireland or booked in other countries. And I was just wondering how that shows up in the statistics here. And could we be sort of undercounting US assets abroad because we're not fully capturing all of the intellectual capital that Apple holds in Ireland and so on?
Okay, so if you're okay with it, you might want to cut me off because of time. Let me just show you our concept of measurement, so you get exactly this question. So what's presented to us in the integrated macroeconomic accounts is a balance sheet for both. We have one for the non-financial corporate sector and one for the financial sector. And the balance sheet has on the asset side, non-financial assets, financial assets, where all the foreign subsidiaries are, the claims, they're booked as financial assets, that we have foreign direct investment equity and loans to our subsidiaries. That's all here. And then you have financial liabilities. And then there's the two ways we think about measuring. Well, first, when we talk about enterprise value, we're trying to focus on what is the valuation of the non-financial assets. So the fact that Apple has a bunch of cash, we want to strip that out. So what we do is we want to add up these two terms and subtract this. Well, that's for the market valuation. By taking the market value of equity plus the financial liabilities and subtracting off the financial assets, we get an implied market value of non-financial assets, which, like in a corporate valuation course, they would call enterprise value. Mm-hmm. And the replacement value, of course, is whatever the flow of funds sticks in here for the replacement value of the non-financial assets. So those are the two graphs I showed you. So it is true that I think that was one of the first questions Esteban raised. To the extent that FDI may be, I mean, when they try to value FDI, they're trying to say value it by public comparables, Apple subsidiaries by public comparables, and they may mess that up. I mean, for sure, that we don't have any special insight on the BA method for doing it, but it's the same thing they're doing to value non-traded equity already in the United States. It's the same type of procedure. Yeah, but there could be, there could be some measurement issues there for sure.
Thanks.
I'm well over time. Nobody's ringing a bell.
No, we would be having a happy hour with you now, so we're gonna.
I could open a beer.
Yeah.
If you like. I'm happy to stay and answer other questions or those types of things. It's up to you what to do. I mean, I do teach at 4 o'clock my time, which is in 50 minutes, but I can transition over to that at that time.
So I'll ask you a quick one, Andy,
Sure.
just to the follow-up of the point you made about the open economy model, being able to kind of shed light on this intangible versus markup. So can you go through the logic again of the? I want to understand basically, what kind of measurement assumption are you making when you say that we should see a big increase in current account deficit? I mean, what are you assuming about what is measured about intangibles?
Okay.
Intangible investment.
So, okay, so
I missed that step.
Okay, so the first step in the analysis is to first say, okay, if we're going to go that it's capital accumulation that drove the increase in value, and it just happens to be unmeasured, then we have this logic of Tobin's Q. To get P to go up by 150 percentage points of GDP, the sum of the capital stocks have to rise by 150 percentage points of GDP. And we saw that this one barely moved relative to GDP, yes. So this one would have to do it. And then you would go, okay, so the accumulation of capital, I didn't write down the capital accumulation equation. There's like two ways you could write it down. You could write one where you invest goods to get this unmeasured capital.
Okay, exactly.
And then, so then I have to take some portion of this output, and that's right here, unmeasured investment. And so if unmeasured investment soared, measured GDP would fall dramatically, but Americans would be going, I'm just as rich as I was before, because this is just a measurement artifact. And in fact, we're accumulating this asset. So I'm going to keep spending.
Mm-hmm.
And as a result of that,
We get a current account deficit.
you get a current account deficit.
Mm-hmm.
Now, the other way you could do it is to say that
These are not good. It's not goods.
it's not goods. It's labor that you've withdrawn from current production. And so like you gotta, instead of people making stuff, they got to do R&D or whatever, brand value or whatever.
I was thinking, what? Okay, yeah. Okay, no, keep going. Sorry. Keep
And
going.
then you would rewrite the equation for measured output, which would be something like this, but with labor engaged in production.
Mm-hmm.
And then as you pulled labor out of production to make this unmeasured capital, you'd have the same phenomenon that measured output would fall, but Americans would go, I'm just as wealthy as I was before, so I'll keep consuming.
So what if it's something like learning by doing?
Well, again, okay, but then you're thinking something magically appeared that before we all just had to work and we didn't learn anything, and now we can work and learn a bunch of stuff.
No, I'm just thinking, I'm looking at the math and I'm thinking about a story where you don't have to subtract anything to YM.
No. I guess if you did, something magically happened that by spending 8 hours a day at work, instead of just making output, we also now just make a whole bunch of unmeasured capital at the same time, miraculously. I'd have to think that one through. I don't like to think of that. That seems odd, but but we can think that one through. Yeah.
I thought just kind of another way when I was thinking is that if it's an investment, there should be the inflow at some point that creates the claim on KU, right? And we just don't see it. We just don't see it. Whether it's goods or something else, there's got to be an inflow on the. At period zero, there's an inflow, and then you own this KU, and you're going to claim to that, and we just don't see it
in the data. That's correct. There wasn't a big current account, and in the closed economy, it's financed entirely by just lower measured output, and that one maybe you could have done it really slowly. I don't know. I'm skeptical of that. Most of the analysis.
So what's the sense in which we don't see that, the lower measured output? I mean, it's relative to.
Not enough lower to get you 150 percentage points of GDP in accumulated capital. That's a whole lot of capital, right? That's more than the measured capital stock. It'd be equivalent to saying in the last 10 years, like if we blew up the entire measured capital stock and said, let's start again, it would take a lot of investment to get back up to steady state.
So can I ask you on this, like a nerdy national accounts question? So when you compute your capital, is this capital of the corporate sector or capital of the whole economy?
Capital of the corporate sector.
Okay. What about GDP? Because there's the imputed rents in GDP.
Oh no! So what we did mechanically in each case is like the capital output ratio.
I'm thinking about housing because one.
Yeah, I don't have the graph with me that we did plot. You can from the integrated macroeconomic accounts, like what fraction you can compute every year, what fraction of overall gross value added comes from the corporate sector, and it bounces around 57%. Not that much over this time period. So, since like 1992. So we just use that it's.
Okay, you assume it's proportional basically to GDP.
Yeah.
With a constant proportionality.
Yeah.
Okay.
Yeah.
But when you calibrate the model to the capital output ratio, I mean, I don't know if that changes I mean, yeah, I don't.
So the capital output ratio would be, we said it was
Not the capital
1.2, but the capital to corporate output ratio is 1.2 divided by 0.57, which is like
Okay.
2 point something.
Yeah. Okay.
Yeah. Yeah.
And then the implications going forward, we should be seeing bigger dividend payments to foreigners, dividend and capital.
We argue that we saw it already. The last decade, we've already seen them.
I see.
I mean,
That's the difference. That's the difference with the PE, the
no,
Campbell.
yeah, corporate payouts over output have jumped.
No, I want corporate payouts to foreigners. But I
Well,
guess
they're getting a third of it by assumption.
a third of it by assumption, yeah. That's the difference with the Campbell-Schiller. The Campbell-Schiller wouldn't predict flows, right? Or just predict returns.
Well, because Campbell-Schiller, historically, I think that corporate payouts didn't vary. It's not that they don't predict flows. They just say that, you know, dividend growth doesn't change. And that when I say this time is different, I know I'm going out on a limb because that's how you get made fun of in 10 years. It appears that that's no longer true. We have an episode where there was a big jump in payouts. This is, again, cash flow from operations, not CompuStat dividends. So that, you know, that it's just that in the growth model context, it appears that corporate America is just spitting out a much more money to its owners than it used to. And that occurred after the financial crisis. That jump occurred after the financial crisis.
Okay, in that case, let me just thank you. This was perfect. It was great. And let me just reiterate that we're going to get you out to Princeton as soon as we possibly can, and celebrate more properly.
Thank you very much. I enjoyed this, and it was great to have all these questions. So thank you all for joining. And if anybody has feedback, you know, send an email or do whatever. So thanks so much.
Thanks, Andy.
Goodbye.
And thanks to Jonathan and Fabrizio for their too.
See you guys too.
Bye.
Yeah.
Bye.
Bye.